Right, so we are live, and welcome to April 10th market catch-up and market discussion between Swapman and Cadaver. So to start with, a couple of weeks ago when we had a session, I mentioned that this is the first two-legged pullback, and it will be bought. So as you can see, as I said, they bought the close of this week's close, and they bought the close of here. So this, I expect it to be a very strong move. And if someone asks how much, conservatively, it should be the whatever is being retraced here, it should see at least that much up. So here it's 62 and 50, something like this. So about another 12,000 above this high. So that would be 70, 72, 73, something like this. This is what it should happen. It should happen in a decent time. It should be like like this 1, 2, 3, 4. So around within 4 weeks, it should go to 70 to 73. So all of these, I consider them on a weekly. I consider them a one-legged pullback, right? So you could argue it's a kind of two-legged pullback, but it's professional entries is generally on when there's a big red bar. They buy here or they buy the low of this or something like this. So so this I would still consider the first deep pullback, and this I would consider the first two-legged pullback. So this we generally have a very nice move up. I have bought a position here. I should have bought it here, but because when we do the show, it's already a few hours into the week. So theoretically, we would buy the close here at 58, and we would put a stop. This is the theoretical stop, but it can be too wide on a weekly. So you can have you could do a stop on. So this is where you would end up buying, and you could have a stop here. So this is my read on the market. So good to have your perspective, Swapman. What do you think?
Yeah, so I thought a couple of weeks ago we got an entry. Like, I mean, I'm more of a sentiment trader in general, I guess, and I'm trading like a bit longer time frames. So I've just been mega bullish, and I thought we got in at. I forget what we entered at.
We got in around here. Yes, we got in around here, and we had stopped here. We didn't have a target, so this was a very good entry. You see, the price never went below that.
Yeah, and I actually in my book was adding when it was pulling back. Yeah. To me that was super. Yeah, to me that was super bullish. That you notice that in that spot there when it looks like a little mini rejection at 5,900 when it got sold down after either there or the one before. This to me was just leverage getting squeezed out of the system. You could tell one of the things that I look at to monitor for this are I look always at the futures curve, and I look at the perpetual funding rates. And whenever those perpetual funding rates are squeezing like above 0.2% every 8 hours, which on an annualized rate we're talking like getting from like 50 to 100%. This is a danger zone for me. And that means that people are over leveraged long, and they're susceptible to getting squeezed out. And so when that I think was pretty typical of what we see there on that like fake rejection to me. And when people are forced selling because they're over leveraged near the top and then getting close out of their positions, that's something that I want to buy, and that's what I was buying there this week.
So you entered around 56, or you entered around 57 here?
Yeah, I started at 57 and added at 56.
Added it here. That makes sense. So I know that many have this dry powder concept, and it's a good concept that if you have say $100. When you see a drop like this, you don't put all your $100. You put, I don't know, 20 or 50 or something like this. So do you have a kind of a heuristics to say that, hey, if I see a drop, I'm going to commit, this much more of, this percent of my allocation for buying?
Yeah, I mean, I guess you could say it's like a variation of like Kelly criterion, which is kind of like the standard approach that most people are using when it comes to bankroll management and risk management. But yeah, like I'm just massaging a long position, so I'm maintaining my long exposure, and when I see opportunities like pullbacks, I'm just adding on to it, but not getting myself over leveraged, because that's what a lot of the traders that are getting forced out is that they find themselves in a position where, oh, okay, I'm so excited for the level to get broken that I'm just going to bet too much. I'm trying to avoid that entirely. So maybe I'll be like 3x long. This is actually exactly what happened to me. I was 3x long. I saw the pullback to 5,700, and I was like, all right, let me boost my leverage, add more to my position size, and get to like 4x. And then when it pulled back to 56, then was hitting the offer and getting up to like 5x, and that's my comfort zone. Is that I monitor my leverage ratio, and that sort of tells me whether I'm getting a bit out of control in terms of how aggressive I am on the position.
And when you buy here, if the price moves up, like here, for example, it moved 59, do you take profits here or do you just let it ride?
No, I'm letting it ride from that point. I'm not trying to massage the other side too aggressively, because I'm positioned for the upward break. I feel, we're going straight for 66K on this next week. I would be surprised actually if we don't get all the way to like 70K and above before it starts to pull back. And that's the kind of target zone where I would be massaging out of that long position. I don't want to reduce unless of course it's pulling back much more aggressively, but I'm not reducing until it's getting above 66K on this move.
Right. So you have price based criteria as to when you're going to take profits and so on, and that is a very common and common sense way to do it. If I would I didn't trade anywhere here, so I'm kind of busy with my other other commitments. But generally, when I see a small pullbacks and a deep pullback, I don't enter immediately. I generally wait for sign of strength. So, for example, this would be a sign of strength. And then after it goes below that, that is when I would enter. So I would, I would enter. I would just skip this and I would enter here. But if you are, because I, generally try not to do more than one entry per retrace. So, but I guess your strategy, which is also, I guess it's a much more fine-grained control, is you can say, hey, every red move I'll add on a little bit, and every every new red I'll add on a little more. So that gives a little more fine-grained control. And because you are 3x, the net impact is is not a lot. So you entered at 57, you entered at 56. That's not a lot of difference in the when you look at how much how much upside you're looking at. So for people who are trading at higher leverage, this can make a lot of difference. If you entered here, and this could, if it moves this much, it can, in percentage terms, it can be a pretty big loss.
Yeah, and I would say if you're trading on higher leverage, like a lot of people are out there scalping, or they're like trading strictly on short-term momentum, then I would not trade the way that I was just describing. Like I'm doing swing trading in this current market environment, where I'm just positioning myself for a continuation of the trend. For people that are trading shorter time frames and are riding breakouts and stuff, then definitely don't capture, like if you're going long, don't capture drops. You want to, like you mentioned, Contango, to jump in when there's strength, follow that, getting on that strength. You don't want to be like trying to capture the moves coming into you.
Right, and another consideration, I guess, is position size, right? So the size of positions you are trading, it's simply impossible to trade 100x. You cannot put like I'm just throwing a random number here. You cannot put $500,000 or even 100K at 100x. It just wouldn't make sense, because you are looking to build a long-term trend. I mean, you're looking to ride a long-term trend, and essentially your real view is something like this. It's like a daily, it's like this, and you are looking to get you're looking to enter on a long term, on a deeper retrace, and you're trying to essentially ride the trend as far as it goes into perpetuity, right? All crypto people, like when it comes to something like Bitcoin, have a permanent long position. So what would be the advice for someone who wants to essentially expose themselves to a permanent long position? Like how would you trade, a trend like this?
Yeah, I mean, this is basically what I've been managing, and so. But the number one advice is first to like you said, maintain a spot position. So you should be holding Bitcoin spot. That way, you're not paying any funding rate. You're not getting in, um, on at any kind of like premium that you have to pay. There's no funding costs. There's no margin of interest that you have to pay. So always staying long on Bitcoin flat without any leverage. But in terms of trading wise, this is actually a very difficult situation, because when we are in a bullish cycle, you're going to get a steeper contango in the Bitcoin futures curve, which means it's going to be more expensive to get that long exposure. And the same when you're talking about perpetual swaps. If you're maintaining that long position, you're going to be paying annualized rates of something like, and this is without, not against your equity, just against your position. You're going to be paying rates of like 60% annualized, which when you consider that on your equity itself, depending on your leverage, we're talking about like 3-digit annualized cost just to maintain that position. So I try to generally avoid actually perpetuals when it comes to longer term positions. I prefer to get long further out on the futures curve, where you pay. So the primary difference between futures and perpetual is that on perpetual you're paying a variable rate. So you're getting long, and there's some kind of funding rate that you have to pay in the short term, but it's going to be varying, and you don't know what your funding rate is going to be tomorrow. You don't know what your funding rate is going to be in a week. So you're exposing yourself to this variation in the path of interest rates, and because in the market for Bitcoin, you have this imbalance between the dollars that are available for people to borrow to get long, and the desire for people to borrow those funds to get long. That you end up having these really high rates, which feed into the futures market and also feeding into the perpetual swap market. So the most difficult thing to do when you're getting long, even if you're correct and you're getting long, looking at this chart, and you're getting long at these different points like 32K, and you're doubling your money within a couple of months in unlevered terms. You have to consider the fact that you're doubling your money or quadrupling if you're on 2x leverage or whatever, that you also have this funding rate cost associated with it. So my advice is, when the curve gets flat, like it was late last year, then getting long on the longer dated futures is the most like cash flow economical way to maintain that long position. So you're not having to expend cash flows to cover perpetual rates or a margin borrow, and you're just basically you're getting in at a fixed rate. So when you enter, there's a fixed premium that you're paying of spot versus the futures that you have gone long on, and usually in a bull market that will actually expand. So by the time you want to unwind your position, you're actually not even unwinding at a worse rate. You'll actually even get an extra bonus because the rate will get even more bullish by the time you're exiting. So that's usually the way that I prefer to do it, because perpetuals are, what you're really doing when you're perpetual long is you're basically paying market makers who are doing the carry trade against you, which is fine. You can still make great money. It's just that, when you look at the chart and you're doubling, you're supposed to be doubling your money. You're actually not doubling your money because you've been paying 80% annualized rates in order to fund the position.
Right. So why are perpetuals so much more popular than regular futures?
I think because they are, I would say just on that point that probably like 80 to 90% of volume in the futures and perpetual swap market is perpetual. So you're right, it's way more popular, and I would say it's more popular because market makers are very, very willing to provide liquidity at those high funding rates. And I think from the flow side, people are, they find it more intuitive. You don't have to think about, expiration and, what does it mean that it's a future value of Bitcoin and the price is reflecting the future. You don't have to think about that. It's just perpetual is like trading spot, basically. So it's just meant to follow the underlying market much more closely. And it feels like you're trading normal margin, like you're even paying a funding rate, just like you would be paying a rate if you're borrowing dollars to long Bitcoin.
Right.
So it's more intuitive, I think, for a lot of traders. I've always found, in my experience explaining futures trading to crypto people, that they always over intellectualize and try and think too much about like, what is it like? This isn't actually trading Bitcoin. This is Bitcoin in 3 months. And is this like a crystal ball of what you think it's going to be? And they don't understand the financial engineering underneath, which I was describing before, the sort of whole mechanism of how the rates are impacting the value of a futures contract. But with perpetual, they don't have to think about that much. It's just like, this is basically trading spots with some kind of funding rate mechanism on top.
So perpetuals are an ideal instrument for someone who likes to trade counter trend. So there are people who all they do is short a bull market. It's just some people intuitively, when they see a market go up, they always think, I'm going to short this. So for them, this is a better option, is it? Because the funding works in their favor, even if they overall would have made more money trading on the side of the trend.
Yeah, but so I mean, we're not talking about just like dumb bears that are shorting the bull market. We're talking about sophisticated trading firms which are buying Bitcoin spot and then they're shorting the perpetual so that they're maintaining a delta neutral position, and they're paying nothing on their spot long, and then they're receiving these really high perpetual funding rates from people that are getting mega long, bidding the perpetual contract above spot, and paying a bunch of funding to hold the position. So these guys are meeting with the people that are super bullish, and it's still positive EV. You look at the chart, look how bullish it is. So of course I'm willing to pay 30% annual rate or up to 80 or 90% because Bitcoin's going to the fucking moon. So I'm happy to pay that rate. So it's just like any market, market is bringing together willing participants that have different views. And this is exactly a great example of that. There's people with different views, but they have different sort of agendas, and they're meeting. And of course, that's not to say that some people that are short, aren't short because they think that the price is going to go down and they're bearish. There's lots of people like that, but a significant proportion of the people that are on the short side of the open interest in perpetuals are actually collecting that juicy basis.
I see. So what do you think of this whole the futures curve being so steep?
Yeah, I mean, a lot of people are talking about this now. One of the things that came out was, Arthur Hayes, who is now I believe he's in custody of the United States Marshals, who he handed himself in to the authorities related to the Bank Secrecy Act violations, which is neither here nor there. But that's he wrote an article before this on April 1st. Yeah, this is what you're showing here, which outlines basically a lot of stuff that I was just discussing about how the mechanics of how this the futures markets in Bitcoin work, and why people are able to provide liquidity for it, why people are paying high interest rates in order to get that long exposure on Bitcoin. And so, this is also something I've written about for 7 years or so on BitcoinFuturesInfo.com and stuff. But then JP Morgan also came out with a report where they were basically trying to shill this trade to normal institutional investors, because there is the CME futures, right? And so that's an opportunity for people to short the futures there, but there's not really a nice regulated spot leg of the trade. You do have the Canadian ETF, but there is no US ETF or any other proper ETF. And in order for someone to pull this trade off in the purely traditional way, where you're not actually buying Bitcoin, would be cross-margining a long Bitcoin ETF position with a short CME Bitcoin futures position. That way, you're capturing that basis, that premium that exists in the market, pretty effectively. And so anyway, JP Morgan did a report where they were like, oh, look at these crazy, look at the Contango that's so steep on Bitcoin. Some of these rates are like 50% annualized on US dollar return. And basically there's just a lot more attention in general around this trade, which those of us who have been in the, early on in the Bitcoin futures market, we've been doing this since 2013. Like, the market and the availability of doing this has been for a very, very long time.
Right. Yeah. So I do think that there are two kinds of players in any large market. One is the house and one is the gambler, right? The house is willing to the house looks at low risk, low reward, but high volume, right? Whereas the gambler looks at high risk, high reward, and only when they meet, you're going to have a dynamic market. So in crypto, even the house, which would be doing what you described, would still get a very decent return compared to even a regular casino, right? So you would, if you hold Bitcoin spot long and short futures just on the premium, if it's really 100% per year, that is a very significant gain. Even casinos don't make that much, right?
Yeah, I mean, exactly, and that's what makes it so attractive for people that are holding dollars in an environment. And this is a point that is worth making in this overall topic, is that we are in a crazy zero interest rate environment for US dollars, and negative interest rate environment for people who are unfortunate enough to be in Europe, dealing with the euro or Swiss franc or similar, where you're paying the bank just to hold any meaningful amount of money, which is absurd. You're getting taxed just to hold cash, which is incidentally a reason why a lot of people are getting into crypto, because the opportunity cost is too high. You can't sit there and get crushed in cash. You have to. It's better to buy tech stocks. It's better to buy cryptos, but anything other than sitting in cash. So in this kind of environment, there's desperation for yield, and even if you don't give a shit about Bitcoin and you see these opportunities in a purely financial sense, there's great yield to be had. And I think this is going to be going forward more and more of an on ramp for people who are crypto skeptic, but they see the opportunity to get yield on their fiat. There's so many opportunities everywhere, whether it's providing liquidity on something like Curve, a stablecoin swapping platform, or doing this basis carry trade on futures, or selling covered calls on options. Lending out to margin traders, which is something that I've done since 2013 as well. Just these back in the day, Bitfinex had these total return swaps, and I was major provider of liquidity into these markets where it's just too good to give up. Where people that were borrowing, they were desperate to borrow USD to get long crypto. I had spare USD, and that was an opportunity to get great yield.
Yeah. No, that's why you are swap man, right? That's how you got that. No, that's great, and I think that we are still at the beginning of this revolution, because once the gas fees on Ethereum or whatever, once there is a solution to this problem, I see, it's just like a black hole eating a star. It's just everything from the traditional financial system is going to get sucked up here, and all the capital is going to move here. So I would think that we are still at the very beginning. This is essentially, to use a overused cliche, we are still in the 1999 of the internet revolution.
Yeah, I mean, that's one way to look at it, but that kind of implies that we're going to have a massive bear market in the next couple of years. But I don't know. Honestly, I don't disagree, and I don't fear bear markets. I feel like the last bear market that we had was very healthy. I think people that stuck around and were building and focused on developing out the technology, that helped what separated the men from the boys, so to speak. The people that were, or separated the builders from the opportunists, at least the ones that were simply in it trying to make a buck and doing scammy bullshit just to make money, without actually coding stuff. They're gone. Maybe they came back now. They're doing NFT stuff probably, so then they're not totally gone maybe. But the ones that stuck around and were building in that time period and weren't so focused on, I'm going to make a couple $1 million and then get out of here, like that kind of mentality is super unhealthy. And so the builders use those years to build character and to actually create useful products in crypto, and now we're sort of reaping what we've sown in that regard in this recent cycle. But then you get the greed again, and then you get a lot of the general sort of weird bull over the cycle contributing to misbehavior and misaligned incentives. And then it's good. It's natural to pull back and have a bear market period. Not that I think we're entering one at all right now, but obviously, eventually, there's going to be, I think, a healthy pullback.
Right,
but I don't feel it's good.
Yeah, and we've had that since 2012, 2013. You had all the crazy stuff on a much smaller scale, but it's just only 2017. It caught the attention of the outside world, so to speak. But we had fly by night operators. We had people who built great things. We had people who built great things and moved on to other things. We had people who got lucky or lazy or whatever, they made their money and then they said they lost their motivation. So all of that we have seen, and it happens every 3 to 5 years, I suppose. And but you're right. I think this bull market is not. It's still going to run for a while, maybe at least another few months. And then and we will see. We'll either see a blow off top, or we'll see some kind of stupid behavior that will make it obvious. And
I mean, one of the I guess a lot of people are pointing to NFTs and some of the stupid behavior there, a lot of the cash grabbing and opportunism. But another thing which people, I guess some people are talking about it, I shouldn't say nobody is, but the regulatory risk. And remember in 2017, the SEC was pretty aggressive. There was like a lot of notices going out. There was a lot of these guys basically getting in trouble, being told to close down, give money back, whatever. We're not really seeing that at all this time. And we're seeing stuff like BitMEX and Binance getting messed around with, but not really so much these projects that have been, raising money and doing stuff in a similar ICO fashion as before, where they're not necessarily following the rules. But we're not seeing that. Like, it seems like SEC is completely asleep, and there's not really any regulatory action. And even Tether seems to have gotten not in any trouble with the New York investigation. So maybe the regulatory risk is more overblown. But there's definitely some bad actors going on in the whole DeFi space right now. So
right, I think SEC, if I don't recall where I read this, but SEC kind of admitted that it cannot go after every offering simply because there are so many. SEC prosecutes something like 800 cases a year, and they have a staff of like 2,000 or something like this. I mean, this is my old information. It may be different now, but I mean, 2,000 is the number of projects that have raised money probably this week. It's not feasible to just spend like 2 years of investigation on every one of these, and it just wouldn't make sense. So I think they're looking at big actors like Ripple and so on, and trying to, I guess, get some sort of judicial precedents or something like this. But what's happened is the market has become global. You have, someone from Singapore or Mongolia raising funds. It's not practical to go after them. That's what happened with SEC.
But what about the DAO? Wasn't there a paper that the SEC issued about this concept of DAO, that it basically doesn't fly, and you can't just use this as a mechanism to get around securities regulations or whatever? I would think that this applies to a number of the projects going on this time, but maybe this is a deeper topic that we should discuss a different time. But I'm just curious what your thoughts were on that.
No, the SEC is right in their interpretation that just because your corporate structure is non-traditional, it's not relevant to them. For them, what's relevant is the financial activity that you are doing. And if you're offering to US persons, then you come under US jurisdiction. So that is their position on this. The issue is that the SEC, even before crypto, their job is not to go after all incidents. That there are literally, think about it, 800 cases. If only 800 cases of legal infractions happen per year, there's no need for SEC. It's not going to be such a damage to the economic system. 800 is a very small number. The SEC exists for, essentially as they see themselves as like a shepherds who guide their sheep. I'm just giving a stupid analogy, but the way they look at it is that if they take action on a couple of black sheep, then the rest of the sheep will toe the line. So this is how they look at their effectiveness. The problem is the moment someone is out of reach because they are in Russia or somewhere else where there is no way to touch them, your 800 number is not going to have any impact at all on the market. It's just you're going to be completely ignored, and you are going to stop being relevant in this space. And that's what happened. So the SEC will still, I think that they're rethinking the strategy, and they're trying to say, okay, what can we do to still have an influence on the behavior of these market participants. And I think they are saying we're going to target the the big names like Ripple, and see if we can get a very strong judgment, right? And even Ripple and all of these guys are fighting back, and they asked for discovery on all SEC's emails for everything related to Bitcoin and Ethereum to see if they're treating Ripple differently from this. Is there any basis for SEC to consider Ripple as different? And they won that that discovery request, which is, I think, very significant. It's very significant because if there is any email, and by the way, the SEC has to preserve all their emails, they just can't go delete it. If there's any kind of chance that the SEC said in a few emails that, yeah, it's just like Bitcoin, it's just also a cryptocurrency, things of that nature, it weakens their case significantly, right? Because then Ripple will show that this is bias and this and that and whatever, their legal team will do it. So if Ripple ever wins, I mean, if that happens, believe me, the SEC is going to be irrelevant in the crypto space. So this is a very dangerous thing for SEC. They're going to fight it, tooth and nail.
Yeah, but the thing is that, and that's a fair point about, like, there are definitely examples this cycle, but they're really focused, it seems, on the larger centralized guys like Ripple, BitMEX, whoever. I just find it strange that a lot of these DeFi, it almost feels like the DeFi projects are justified in this fair launch approach, where basically the typical example is YFI, the YFI, Yearn Finance, right? Where they gave away, they didn't sell a single token. They gave it away to people in various mechanisms where you had to farm in different pools and you would get it distributed that way. And then these tokens became valuable, like they were valueless at the beginning because they were just giving away tokens, but then they became tokens that were usable to basically govern a protocol which was developed by a centralized team of a few guys, particularly Andre Conche, that would allow them to basically get access to the cash flows of the protocol, which ended up being enormously successful. So I guess the question is whether, I mean, this is more like a legal question, I don't know, but like, has this model been tested in court yet? Is that something that needs to happen before it's validated?
So I think it goes back to the question of bandwidth, right? Like, see, SEC is prosecuting 800 cases, and these 800 cases have to do with the traditional markets. And in the traditional market, there are many obviously bad things happening. So what's an obviously bad thing? Financial advisor, gets authorization to invest $100,000. He invests $6 million from his client's account, like he transfers it, and then he spends it on a car and a house and all of this. And by the way, this is a real case, and things of that nature. This kind of nonsense happens all the time in the financial world, and these are obvious violations, and these are easy to prosecute. So the 800 or even if they double their capacity, right? There is so much for them to do in the traditional markets that they really don't have the bandwidth to deal with the crypto markets. In crypto markets, as I said, 800 is a very small number. There are 5,000 coins and new coin coming every week, and there's a new project every week. And the SEC takes about 2 years to prosecute a case. So think about, there's just no bandwidth to do it. So they have to prioritize, and all law enforcement prioritizes their tasks, and they're going after these really bad people who are doing really bad things.
Yeah,
So
I would. One thing I would to summarize that point, I would say like the ingenuity and creativity of the masses who are interested in crypto is like infinite, but the resources of the SEC and other agencies are finite. So
right. Right, and the model changes every other year, right? So you don't really see ICOs anymore. Now you have governance tokens, and by the time SEC prosecutes and one or two guys, there'll be something else. So like there's already NFTs, and SEC is trying to figure out if collateralized NFTs are a security. I think they did issue a statement saying that if you pool NFTs and issue a token on top of it, it's a security and so on. So but NFTs is going to be something else in a year or two by the time they prosecute. So it's a moving target, and there needs to be a lot of legal research for something that doesn't have precedent, right? So in general, if you look at all the tech markets, the technical stocks, tech stocks in the 90s. It started in the 80s, but really it got visibility in the 90s. Tech stocks started giving amazing returns, right? Like 10x was not unusual at all. I mean, nowadays you look at Apple, Amazon, and say yes, tech stocks are very well, but before 90s, you expect 6%, 7% from a stock, and most of your stocks were like utilities, retail, this kind of stuff. There was no tech stocks. The tech revolution started in the 80s with the personal computers, and then all of that. In the 90s, you started seeing very easily 10x stocks, which was just unimaginable. And mid 90s, you had groups of traders who would trade only tech stocks. You had the web forums and all of this. It all came together, and most of these guys who started trading those were actually tech people, programmers and engineers and all of that. And the reason tech stocks could outperform anything else was because technology was completely unregulated. There was really no regulation at all on what kind of technology you can create. There was a little bit on, if you're using wireless bandwidth, there's some FCC regulations and so on. But in general, you could create a technology, and there's essentially no regulation. You could sell it. There's no competition, right? So the same thing is happening in crypto, but crypto is this magical place, where it's both tech and finance, and there's regulations on finance. There's no regulations on tech, and the magical thing about money is that money touches everything. Technology doesn't even touch everything, right? Like if you have a technology for, say, telecommunication, like let's say for your mobile phone codec or video playing, or it is only in that domain. But money touches everything, right? So this is going to be like the tech boom, but I would say 100 times bigger. I mean, it should be by its nature if there was no regulatory ball and chain, tied to you. So so what is happening is many people see the potential, and many people are blindly aping into all these cryptos, and they don't really care to lose a little bit here or there. It's not like traditional finance where you say, oh, I'm going to allocate 20% to bonds, 50% to equity, all this stuff. Here it's just, there's a new class of crypto. There's this NFTs. I'm going to buy a bunch of NFTs, and I'm willing to lose every penny because if the potential rate of return is 100x, 1000x or more, right? So if it's 6%, you have to think how much I have to allocate. Does it go up or down? Can I just put it in bonds? All of this stuff. But if you are expecting 100x return, all of these considerations go away. You just say, I'm going to buy this new class of thing, right? And anything new, like in crypto, this is how people think, right? What is this new thing? Layer 2 technologies. Well, I don't care. I'm buying $100 worth of everything. What is this new thing? NFTs. I'm going to buy a few of these NFTs. I don't care. I'm going to buy Axie Infinity. I'm going to buy a Punk. I'm going to buy this. So the same thing, exchanges, exchange tokens. Really, it doesn't matter, because if you buy enough, if you buy the top 4 or 5 tokens, one of them is going to make it, right? And the regulatory shackles or whatever is going to have only a limited impact, simply because, as I said, bandwidth. If you're going to have 1,000 new tokens every month, there's no way anything can be done. The government has to rethink how they approach. They cannot do regulation by enforcement anymore. They have to have some kind of cooperation and that kind of thing, which used to exist. I remember, when something used to go wrong, you'd get a call and you talk it out and you show some papers, and a lot of times it would just be corrected without an actual enforcement enforcement action. Because in general there was a feeling that everybody's here to do the right thing, and mistakes happen, and as long as they can be addressed, the system, because the market integrity was the most important. I mean, even now, market integrity is the most important thing. The individual violations, they're only important in the sense that if it's unchecked, it will damage market integrity. This is why even with 800 cases, they can maintain a very healthy market. But if in crypto, there's no such thing. There's no threat to market integrity, right? I mean,
I feel like letting the market just be free is in and of itself like the threat to market integrity in a way, because you see it in DeFi with all the rug pulling and flat out scams where people are investing money into things and that's all just getting taken away by schemes. Like letting the market just do that is teaching people a lesson. It's damaging the integrity to a point where like people are scared to invest, and that's maybe just as good as going after scams to protect the investors in a way. But like, so maybe they're taking this kind of like laissez-faire approach and thinking that this leads to a similar outcome in the end. Anyway, I don't know, and I don't know what. I mean, I don't believe that there should be like no regulations whatsoever in general. Like there are certain areas like where you're eating food or drinking water, like regulating the quality of these things in the when it's being sold to the public. It makes sense, stuff like that. When it comes to markets, like financial markets, I'm less convinced about how useful a lot of these things are. But and there are people that are getting hurt. There are definitely like not enough people, obviously, because people who are starting new projects are they're even if they're not doing anything of value or producing any kind of product or anything like that, it's still very popular and they're able to raise money, and people who are aping into them are losing money, and until there's enough people that are losing money that there's no more money coming into the system, like, and then we have a proper sell-off, that's where you get victims, and that's where you get complaints. Like as long as people are making money, you don't really get complaints, and when most people are losing money, that's when they start saying like, oh, where's the government to help me in this?
Right, and that's true, and I think you put it succinctly that when a significant amount of people lose money, that is when everyone calls the regulators. Regulations, I don't think they're a bad thing. I think the key is to keep them simple, predictable, and enforceable. And in the world of finance, the truth is nobody understands the regulations. Nobody understands. I mean, at the high level, you understand what these are. Like as I explained, the whole SEC way of thinking and all of that. At the high level, you understand the purpose and the structure and all of that. But if you look at individual regulation, you will notice that you will not understand anything, because most of these have to do with reaction to an incident that happened in the past, and that caused them to very quickly think of, oh, this bad stuff happened, how do we stop it? Hey, what if we make them do this? So this is essentially the story of most regulations. And a lot of the regulations, so Congress doesn't really write regulations. They do create law, and some of the nitty gritty is actually left to the regulating agencies themselves. And it's very interesting thing, because the regulatory agencies, they also have an administrative law judge. So the regulatory agencies are essentially, they have legislative, executive, and judicial powers. They're all powerful in that way. There's no separation of powers. Um, so um, so I think the predictability and the simplicity are missing in financial regulations, and I think it's just a matter of time. If something exists for 100 years, like the financial regulations, it will all become very muddled. So maybe it's time to just say, hey, this is our goal. This is the outcomes we want, and therefore, I think these are the 5 simple things we do, and this is how we enforce, right? I have to admit that all of these exist to some extent. So, for example, CFTC and SEC have a enforcement guidebook, a handbook that everyone needs to read. Whether you are on the enforcement side or on the development side, if you read it, you will understand how they think, and you should read the actual enforcement actions. So then you'll understand the meaning of the words in the regulatory text. So, for example, something like when there's a word like offering, you don't know what it is. If you read all the cases, then you know, okay, this is offering, this is not, this is offering, this is not. It's a kind of mess. It has become a mess. It started with good intentions, and I think in general, I think this is the net outcome is that incumbents are helped, and new entrants who don't have the money, the lawyers, it really costs a couple of million to have a regulatory clearance for anything, and the time it takes, it takes 2 years to get regulatory approval. So I think that's the issue, and until they fix it, I think crypto will remain unregulated. No one is attracted to spend a couple of years and a couple of $1 million to essentially deploy their smart contract on Ethereum. Like no one thinks, I written this smart contract, let me spend a couple of $1 million and 2 years to deploy it, because forget 2 years, in 2 months your idea is obsolete, right? So that's the issue.
Exactly. Yeah. So, I mean, I don't think it's I guess I just don't think it's practical for them to. I mean, I agree with what you're saying, that of how they could regulate in a sensible fashion, but I just don't think there's ever going to be a proper framework that would effectively control the market, or to also allow for innovation to flourish. I just don't. I think that's an impossible balancing act to maintain.
Yeah, and it's because the market is evolving so fast, so you cannot keep up with it. So I think until the market settles, and which could be 10-20 years from now, I don't think there'll be any kind of meaningful regulation that people are going to understand. Like the issue is, I'm from finance. I have a decent understanding of law. I'm not a lawyer, but I have kind of when you're in this field, you have to understand it. But I don't understand most regulations. I just have to, and when I go to lawyers, 2 lawyers will give 2 opinions. This is, it doesn't happen in any other field, right? You go to a doctor and he'll say, you have diabetes, take this medication. You go to another doctor, he'll say, well, you have diabetes, you can take this or this medication. But no one will disagree that, what disease you have. In law, is very different. Every lawyer, and that is why there are so many lawsuits, right? So, Ripple lawyers think Ripple is not a security. SEC thinks Ripple is a security, so they're fighting over it. It's just because I think the forces that create regulation are essentially disruptive forces, and the forces that create innovation are also disruptive forces. So you are in a situation where the best value that you create invariably butts its head against the wall of regulation. It's just not going to. It's not something you can avoid. So until this space settles and there are like 10, 100, something like this products that everybody understands, they use, they understand how it works. There's sort of best practices. I think only then some meaningful regulation can come out of it.
Yeah, I mean, I think in the meantime, crypto is just going to keep doing what it does. That's the beauty of a decentralized global movement. That it's just simply unstoppable when it comes down to like the state can't do anything about it.
It's lovely, yeah. And I think we've come to the end of our time today. It was a great discussion. Hopefully, we'll have more next time as well. Great talking to you, Swapman.
Yep. Yeah, it was great talking as usual. And yeah, I think particularly the legal topic is very interesting. So always good to hear your insights on that.
All right. Thanks. Bye.